Can you mute your mic, please? Let me share my screen. In our last class, we were actually discussing companies' income tax, and I told you the requirements for companies filing returns. What are the contents that is needed by a company when they are filing returns? We discussed exemptions to filing returns. We said there is every possibility that company will not be able to file returns. Why? And this reason is not far because we said when a company is not able to file returns, such a company must have discussed or informed the tax authorities before the deadline set by the company by the tax law. You remember we said for a company, when a company is just being newly incorporated, such a company must file its returns within 18 months from the date of commencement and first within 6 months of accounting year end. Now, anyone that comes earlier, the company must file its returns. We also said for an existing company, such a company under the tax law must file its returns within 6 months after the accounting year end. I remember vividly that we talked about a Nigerian company and non-Nigerian company. We said a Nigerian company is a company that is incorporated and registered in Nigeria. That is a Nigerian company. Now, we also said a non-Nigerian company is a company that is not incorporated in Nigeria. However, such a company's income could be subject to tax in Nigeria. We gave criteria for which a company that is not registered, that is not a Nigerian company, shall be subject to tax in Nigeria. Mohammed, good morning. How are you? Thanks for greeting. Now, so we said such a company would be subject to tax in various ways. So, and I remember in our last class too, we talked about relationship between companies and its subsidiary, relation between a Nigerian company and its branch. What are the tax implications of this? We discussed all this in our last class. So you remember we said a holding company and its subsidiary, they are two different entities. For the purpose of tax computation, these two companies shall be assessed to tax differently. So, what we are trying to say here is that if you have a subsidiary and you have a holding company, okay, the subsidiary company is going to be subject to tax differently from the holding company. And by implication, the only tax implication there again is that the dividend made by this the dividend declared by this subsidiary will only constitute what will be given to the parent company. And you remember again in our class, I have told you that dividend is franked investment income because the dividend, please mute your mic, please. Because we said dividend would have been subject to tax in the hand of the recipient at the point of you receiving it. That means the recipient company would only receive dividend net of tax. Therefore, it is not going to be subject to tax any longer. That's what we said. We now also said, okay, what is the relationship between a subsidiary company, a Nigerian company and its branch? You remember. We said for the purpose of tax liability, a branch company and the head company, head office. Let's put it that way. A branch company and a branch of an head office is seen as the same with the head office. So what I am saying invariably here is that, for example, I cited an example the last time where I said Zenith Bank or GTB, for example, has various. I'm not projecting my screen yet. I'm just talking, okay, Jubril. I'm just talking. I've not projected my screen, but let me quickly do that so that everybody can be on the same point. Hold on for me, guys. Okay, let's project. Oh God. Let me know if you can see my screen. So this is where I am in the study pack. So I was explaining that for a parent company and its branch, and I was citing an example of GTB. I was saying that GTB, wherever they have their branch, GTB is going to be seen as one. Okay? And it is going to be subject to tax as a single entity, irrespective of where GTB has branches all over Nigeria. GTB will be seen as one. So in terms of reporting of profits, in terms of assessing them the tax, we are going to be assessing them the tax as a singular entity or single entity. Unlike when it is a subsidiary, the subsidiary will be assessed the tax differently from the holding company. So, and in my last class with you also, we discussed situation where a non-Nigerian company or a non-resident company could be subject to tax in Nigeria. We said number one, through a fixed base operation, habitually operates in Nigeria through an agent authorized by the company, or maintain a stock of goods or merchandise in which deliveries are regularly made in Nigeria. And we now said where there is a single contract of survey, delivery, or installation, or construction, the profit from that situation will be subject to tax in Nigeria, even though it's a non-Nigerian company. Now, we also talked about the importance of significant economic presence in Nigeria, where a company is present in Nigeria through its digital footprint. Now, the fact that you are present in Nigeria through your digital footprint, what does that mean? What are the things that such a company will do that will make the company be seen as making income in Nigeria? We have said where the turnover of the company is equal to 25 million or more in Nigerian currency or in other currency, such a company will be termed to have been significantly present in Nigeria. Now, the next one is where a company uses a domain name. Your domain name is reading Nigerian domain or is registered in Nigeria. That means such a company is seen as making income in Nigeria and is significantly present in Nigeria. By implication, such will be subject to tax in Nigeria. So we talked about where you have stated your price in Naira term. That means you're trying to target persons in Nigeria. Then we have said that your transaction is significantly present in Nigeria. Having said this, I also remember I said what are the things that could also be done that will make such company a Nigerian that should be significantly present in Nigeria. We said this transaction involved a company downloading digital content in Nigeria. Oh yeah, downloading or streaming digital content. Transmission of data collected by users in Nigeria, or a provision that links a provision of goods and services directly or through a digital platform. Okay, when you provide goods and services directly to a Nigerian through a digital platform. Now, there's another service that we call intermediation service, which has to do with a company trying to link buyer to supplier, affiliate marketing. That's what we're trying to say here. So you are linking buyer to supplier. So any income that is generating from that will be subject to tax in Nigeria. Those are the things that we discussed in our last class. And we also said where a non-resident company providing professional consultancy, management, and technical service renders this kind of service to any person in Nigeria, okay? Now, even though they are not in Nigeria, but you render these services to persons in Nigeria, okay? We are saying that this transaction will attract a withholding tax of 10%, and that will be treated as the final tax liability for that purpose. Okay. So, having said that, we move straight to the next one, which is, I remember in my last class, we've talked about all this. In my last class, we were already talking about payment of tax liability. That is where we are currently. And I told you specifically the tax liability will... Any question? Jerry, do you have any question for teacher? Okay. If that is the case, we can move forward. I told you last quiz specifically that tax liability of a company could be in 4 different ways. Companies could be subject to tax in 4 different ways. The first one is company could be assessed to tax liability on its dividend. Company could be assessed to tax liability on its total profit. Company could be assessed to tax liability on its turnover. And company could be assessed to tax liability on minimum tax. So we're going to be taking them one after the other. We take them one after the other. If you have a question, do not hesitate to call me back. We are on a very steady pace this morning, and I would want you to call me back at any point in time where I explain something and you do not understand. Okay? All right, let's move ahead. Okay. As I was saying, I said companies will be assessed to tax on 4 different scenarios. We talked about based on dividend, based on turnover, based on total profit and minimum tax. So let's start with dividend. Now, Section 19, subsection 1 of SITA put it this way, that a company will be subject to tax on its dividend where the following occurs. Where the following occurs. Number 1, there is no total profit. Number 2, there is total profit, but the total profit is less than dividend declared. Okay? There is no total profit. That is number 1. Number 2, there is total profit, but the total profit is less than dividend. According to the Companies Income Tax Act, such a company shall be subject to tax on its dividend. This brought a lot of issue because some people would argue that dividend that is being declared is probably from retained earnings. Imagine a company that does not have that does not make profits, okay? Or they make profit and the profit is less and they declare a dividend that is more. And the tax authority is saying that, no, you told us that you don't have profits. Why are you declaring more than what you claim that you have? That means you are hiding a particular profit. So there are various proponents to this where argument came. Tax authority and the taxpayer faced a lot of issues with themselves. Okay? So before 2019 Finance Act, This is what used to happen. Where there is total profit or there is total profit that is less than dividend declared by the company will be assessed to tax on the dividend. That was the position before 2019 Finance Act. After 2019 Finance Act, Section 2 of Subsection 19 was introduced. Section 2 of Subsection 19 was introduced. Now, what is that saying? It is saying that, okay, we understand what is happening, but to solve the problem that has been occurring in subjecting the taxpayer to tax on their dividend, the provision now says, okay, if the dividend is payment from the following, it is going to be exempted from tax. If you can prove to us that the dividend was paid out of retained earnings, if you can prove that the dividend was what? Paid out of retained earnings, such a dividend shall be exempted from tax. If the dividend is a payment from retained earnings, such will be exempted from tax. That's number one. Number two, if the dividend is from profit already exempted from tax, profit paid, profit that is the dividend paid out of profit that are already exempted from income tax, profit already exempted from income tax. Example of the act that could exempt profits is pioneer legislation that Mr. Idris must have taught you. Mr. Idris taught you pioneer legislation. Has Idris taught you pioneer legislation?
Not yet.
Okay, so he's going to teach you. Dividend is exempted during the pioneer status. Okay, dividend of a petroleum company is exempted. There are some dividend that is exempted under capital gains tax. So this act is now saying that such dividend that are already exempted from tax will not be also subject to tax here. The next one is profit on income of a company that are regarded as frank investment income. Income of a company that are regarded as frank investment income. That is also dividend. I have told you a frank investment income is the income that suffer withholding tax as a final tax liability on the income. Okay, so where it is frank investment income, it is not going to be subject to tax. The next one is where the distribution is made by a real estate investment company to a shareholder from rental income or dividend received on behalf of those shareholders. The dividend would be exempted from tax. The dividend will also be what? Exempted from tax. So it's not going to be what? Subject to tax. So we are saying where it is dividend received by a shareholder from a real estate investment company, then it is not subject to tax. There are criteria for this. Before you can say this dividend is not going to be subject to tax, at least 75% of the dividend must be distributed. At least how many percentage? At least 75% of the income must have been distributed to the shareholder as dividend. That's one. And this distribution must be done within 1 year. So we are going to be talking about real estate investment company in details in our subsequent class. So let's go back to an illustration. You remember we said companies will be exempted from tax where the dividend was paid out of retained earnings. Okay, you remember we first said what are the criteria for assessing company to tax on dividend? We said number one, where there is no total profit. Number two, there are total profit, but the total profit is less than dividend declared. That means we said the company shall be subject to tax on its dividend. Now, we now said, okay, if that is the case, no problem. If you are declaring tax on the dividend of the company in such scenario, now said it is possible that the dividend has been paid from retained earnings. If that is the case, then the dividend must be exempted from tax. If that is the case, the dividend must be exempted from tax. So let's go. Let's see the first illustration. Let's see the first illustration. In this our first illustration, we said an extra from the financial statement of Retention Policy Limited for 2021 shows the following. Loss for the year, 1.5. Retained earnings, 11 million. Dividend declared, paid in 2022, 1.5 million. Now, from what we explained so far, what is a appropriate way in dealing with this situation? Robin, if you want to say anything. Debbie, you want to say anything? Mohammed, do you want to say anything? What is the appropriate way in dealing with this scenario?
Okay, let me try.
Go ahead.
Okay, so far, since the company did not make profit for the year, you said dividends will be paid out based on the company's the company will be assessed to tax based on the dividends paid. So I think that's what we assess the company's tax based on the dividends paid. Since they didn't make profit for the year, although they had retained earnings brought forward. I don't know.
Okay. Who else is going to try?
Hello, sir. Please,
Yes.
my own take on
Jerry.
this thing is, good morning, sir. My own
Yeah.
take on this thing is the company is not going to be subjected to any tax, in the sense that the dividend they paid was from the retained earning. And probably it seems as if the retained earning has already suffered tax before. So they will not be subjected to tax based on what this thing section 19 and 1 and 2 has said or spoken. So I don't believe they will be subjected to any tax, since the dividends declared is from retained earning and they made loss.
Thank you, Jerry. Who else? Akinpelu.
Good morning, sir.
Morning.
Yeah, I
Yeah.
think I concur with the last speaker. The dividend paid is from retained earning, because we can see from the financial statement that the company made loss in the year under review. So the dividend paid was from the retained earning, which might have suffered tax in the year of accounting. So the company will not be subjected to tax this year, in line with the Finance Act.
Thank you. Jerry and Akinpelu are correct. Okay. Now let's go back to your dividend policy. When you're talking about your dividend policy in your strategic financial management, you'll remember that when you're talking about retention ratio, when a company makes profits, two things will happen. It is either you declare all the profit as dividend, or you retain it. If you do not retain, if you do not declare everything as dividend, you can declare portion of it as dividend and retain some, right? Before you talk about retained earnings, for example, retained earnings, the profit that made that retained earnings, it is retained earnings is profit after tax, right? And by the time you have deducted your dividend, you have your retained earnings, right? So we are saying that this profit, for example, had been subjected to tax in the prior year. And now, because the company did not make profit, we went to prior year again to go and take dividend from our retained earnings. Then that retained earnings, the profit that we have paid, that we have declared, this 1.5 million that we have declared, will not be subject to tax because it is evidence that the company this year did not have profit. That means they must have taken this 1.5 million from retained earnings. Therefore, it is going to be exempted from tax liability. We move on. Let's look at the next illustration. Illustration 2. Look at it very well and let's discuss it. Who is helping us out? VC. Say something.
Okay, good morning, sir.
Good morning.
Okay, so the profit the company made for the year is 11 million naira, and then the dividend declared was 15 million naira.
Yeah.
So about 4 million naira was paid from retained earning.
Solid student.
So the 4 million naira will be exempted from tax.
Good. That is it. The 4 million must have been paid from retained earnings because it does not make profit of 15 million. So where did they see the remaining 4? The 4 must have been taken from retained earnings. Therefore, the 11 million will be subject to tax, while the 4 million will be exempted. We'll move to the next one. Okay, this is the next one. Don't talk if I did not ask to talk. There are some people that have not talked in this class ever since we started. I'm coming. Okay. Yadima. I think she just joined us. Yadima, can you talk? Say something on this other topic.
Yes, sir.
Good. Say something. Just say anything, whether you are correct or not, no problem. Let's see your thoughts. Oh, yeah. What do you think about this scenario?
That's scenario 2.
Scenario 3. Okay. Who else?
No exemption.
No exemption. Thank you, Robin. No exemption. Because the dividend was paid from where? Profits. Okay. So the entire profits here will be subject to tax. Let's go. The dividend of 42 million declared and paid will not be exempted from application of section 19, subsection 1. Since the accounting profit of 52 million in the 2021 is greater than the dividend paid for that year. So there is not going to be exemption. We are not going to exempt the company from tax. Do you understand? Note all these scenarios because we are still going to meet them as we go ahead. Okay? So let's go. We'll move. So the next one is payment of tax liability on turnover assessment. Now, turnover assessment is also a form of anti-avoidance measure that the tax authority use on their taxpayer. And this is what I mean. This is what I mean. A company had come to the tax authority and told the tax authority that, my people, I did not make profits. Okay? There is no accessible profit. That is, the company had declared that they made loss. Or there is accessible profit, but it is less than expected. Equity Professional and maybe another tuition center, let's say Evolving Professionals Limited, are in the same business of teaching and lecturing. Okay. Equity professional has informed the tax authority that, okay, we made 25 million as our accessible profits. No problem, right? Now, involving professionals inform the tax authority that the business environment has been so poor that we did not make as high as 25 million, that we only had 5 million as our accessible profits. Okay, no problem. So the tax authority will now use its judgments. That's okay, where I cannot assess this company based on the fact that the company has told me that they made loss, or the loss or the accessible profits is less than expected in the industry where they are working, then a fair proportion of the turnover will be assessed to tax. So the tax authority will now be forced to go back to your turnover. Let me see your turnover. So it is that fair proportion of the turnover that will be subject to income tax liability. Any question? Okay. That is what we are talking about. We move on to the next one. CIT based on total profit. We are still going to do computation on all these things that we're talking about. So be rest assured that I have got your back. And also, it is very important that I explain all these principles to you so that by the time we get to computation, you'll not be asking me, why is this one this? Why is this one that? You already understand the basis. Let's go. CIT based on total profits. Now, this is going to be on our total profits. And how do you get your total profits? Your total profit is the income from all sources that the taxpayer would have made. And in computing it, I'm going to have my accessible or adjusted profits, add balancing charge if there is any, subtract loss relief if there is any, and subtract capital allowance. Then I will have my total profits. On this total profits, I am going to subject the taxpayer to tax on the total profit. Now, how do we subject the taxpayer to tax on total profit? Before 2019 Finance Act, the taxpayer ordinarily would have been subjected straight on its profits without any criteria. And in subjecting them to profits, so subjecting their tax to profits, that will be 30% of their profits. Because government too is listening to the yearnings and the challenges business organizations are facing. Government now came up with 2019 Finance Act and exempt some certain company from payment of tax liability. And therefore, the Finance Act now divided companies into 3 categories. The first category is called the small company. What is a small company? A small company is a company that has a turnover that is less than or equal to 25 million. Before now, before 2019 Finance Act, we used to have what we call a small business. What we say a small business then used to be a business that has a turnover that is less than 1 million, less than or equal to 1 million naira. And in terms of this company, the company, because it's a small business, the company income tax rate then used to be 20%. So for turnover. Now, because what we are currently witnessing in Nigeria is abnormal because of the situation we find ourselves. 25 million naira is no longer regarded as substantial amount of money again. Unlike in the past where 1 million was a big deal. But now 25 million naira is not a big deal any longer. And that is why the small company threshold is now 25 million. That means by implication, if whether you make profit or not, if your turnover is no more than 25 million, that is less than or equal to 25 million, you are expected not to pay tax. You are not going to pay tax. The next one is if you are a medium-sized company. What is a medium-sized company? A medium-sized company is a company with a turnover that is higher than but less than 100 million. Higher than 25 million, but less than 100 million. Do you understand that? That means this company is a company that has a turnover that is higher than what? 25 million, but less than 100 million naira. In that case, the tax rate will be 20%. The tax rate will be 20%. The next one, a large company. A large company is a company that has a turnover of 100 million and above. Has a turnover of what? 100 million and above. That is a large company for you. Okay? Do you have any question for me? Now, note that when you are computing your tax liability, it is not the profit that the company made that you are going to be looking at. Rather, is the turnover of the company. So if a company has a turnover of less than 100 million, then you are using 20%. Examiner will not tell you this in the exam. But you are expected to know the rates applicable based on the turnover of the company. The next one, minimum tax. Minimum tax is pegged at 0.5% of the turnover, less franked investment income. Less franked investment income. Now, in tax, for example, it is very important that we understand what turnover means. It is very important that we understand what turnover is and divide it accordingly. So, what is turnover? What is turnover? Your layman's language. Anybody?
It's sales.
It's sales. Thank you. Who else?
Income from principal activity.
Babami, income from principal activity. Who else?
Revenue.
Revenue. Who else? Who else? Okay. For the purpose of taxation and for the purpose of this class, turnover goes beyond revenue and your sales. Okay? Let's see what turnover is. Let's see what turnover is. Trying to bring something up for you guys. Hold on, guys. I'm going to stop sharing now. Project my screen, my textbook, so that you can see it from there. So for sales or for turnover rather, turnover covers a whole lot of things that we need to explain. So I'm sharing my screen now so that you can see what Finance Act term turnover. So that when you are confronted with a situation where you need to calculate minimum tax, you will not be tempted to only choose only the sales or turnover as the case may be. Hold on, guys. Okay. Excuse me. I want to share my screen. Can you see my screen? Can you see my screen?
Yes,
Yes, sir.
So look at what the Act define turnover as. Turnover is a gross economic benefit during the period. Don't disturb yourself with that grammar. Whether cash, revenue, someone said revenue the other time, receivable or other assets, etc., arising in the course of operating activity of an entity. When those inflow results in increase in equity other than increase related to contribution from equity participants. That is, we're not talking of capital. Do you understand? We're talking about what will increase your assets, okay? Now, we're not saying such will include sales of goods, supply of service, receipt of rent, interest, royalty, and dividend. I have highlighted it. That means you are saying for gross turnover, yeah, we are referring to sales of goods, that is your sales, supply of services, receipt of interest, revenue, rent, royalty, or dividend. So those will constitute your gross turnover. Okay. Now, when you talk about minimum tax, let's deal with minimum tax now. Let's deal with it. What is minimum tax? I have told you that minimum tax is a tax liability that is charged at the rate of 0.5% of gross turnover, less franked investment income. You know what franked investment income is, which is our dividend. Now, if that is the case, we are now saying that why would we have to assess a company tax on minimum tax liability? Why? We said number one, where the company did not make total profits. The company has said there is no total profits or there is loss. Then the company will be subject to what? Minimum tax. Number two, where the company has a total profit which results into no tax payments. They have a total profits which results into no tax payments. Imagine you remember that there are some profit that are not assessed to tax. Say, for example, profit on disposal of fixed assets is not subject to tax. Dividend is not subject to tax. Any income brought into Nigeria through approved domiciliary accounts, it is not subject to tax in Nigeria. Okay. Now, we are now saying that if your profits arise from any income that is not subject to tax in Nigeria, then we look at minimum tax. We compute minimum tax under your company. The next one, the business has a tax payable that is less than minimum tax. So I have computed my minimum tax. It gave me 100,000. I computed my company income tax. It gave me 30,000. Which one will the tax authority take? The tax authority will take 30,000. Why? Because it resulted into higher tax liability. You remember that the tax authority, in their own wisdom, they would always want to assess a company to tax on the one that will maximize their returns. And in the maximization of returns of the tax authority will always go for the higher. So they will be comparing your minimum tax with the tax liability that you have computed. If the tax liability that you have computed is lesser than minimum tax, then minimum tax will become applicable to the company. So the next one is the company makes a turnover of 25 million and above. That means by implication, a company with a turnover that is less than 25 million is not going to be subject to minimum tax. Okay? So that is that. Now, for insurance company, minimum tax will be for non-life, it's going to be 0.5% of gross premium. For life, it is going to be 0.5% of gross income. Now, gross premium. This means total premium received and receivable, excluding unearned premium and premium returned to the insured. So we're talking about total premium received, except from the one that you are still expecting on hand, or the premium that you return back to your insured. The next one is gross income. This means the total income earned by life business, including all investments, excluding frank investment income. Okay? And also excluding premium received and claim paid by reinsurance. So that is it. So we're not going to be bothering ourselves about this in this class. Mr. Idris that has taught you specialized business would have touched more on all this. So we would actually exclude this from our computation because, again, I do not expect the tax question to go as far back as 2020 or 2021. But in that case, if that is the case, for example, there is a lower minimum tax rate that the tax authority envisaged that the taxpayer will pay during the COVID period. Now, during COVID, because they know that the general economic activity was down, the tax authority, through the Finance Act of 2020 and 2021 Finance Act, 2020 specifically, says that where a company is supposed to pay a minimum tax liability. Now, any transaction that falls within 1st of January 2020 to 31st December 2020 will be subject to a minimum tax of 0.25%. Okay, instead of the regular 0.5%, if the transaction falls within this period, it is going to be 0.25% that you're going to charge. Now, what are the companies exempted from minimum tax? Number one, companies in agricultural business are exempted from minimum tax. A company that has not been in business for up to 4 years is also exempted from tax. A company that earns a turnover that is less than 25 million in the relevant year is also exempted from minimum tax. So that is that. Okay, let's look at this question and quickly tackle minimum tax, and let's know that we are done with minimum tax. Last diet, examiner took this question from my book. This one, exactly. They did not change any word for skills level. This is an extra from my textbook. And they took this exactly from my book. So by implication, examiner also has my book. So any question could be tested from it. Okay, let's go ahead. So, and again, if you want my book in soft copy, it is available. If you want it in hard copy, it is available. For soft copy, you will have a license of 1 year. For hard copy, it's a lifetime. Okay, so if you are interested in the soft copy is 10,000, while hard copy is 16,000. Okay, so that is where we are currently. So in case you want to read further on our class discussion, I can give you access to my soft copy, which is 10,000 for a period of 1 year. Okay, let's go ahead. Let's look at this question.
Yes, sorry, sir. I wanted to ask you a question.
Go ahead.
Yeah, that the company is exempt from CIT. Can you please take it again?
Company exempted from CIT. Company exempted from minimum tax. Is what I said. Do you understand me?
Okay, yeah, from minimum tax, yeah.
So we said companies in agricultural businesses are exempted from minimum tax. Agricultural. We also said number 2, companies that is not up to 4 years in business are exempted from minimum tax. And number 3 is company that has a turnover of less than 25 million is also exempted from minimum tax. So as I was saying, if you are interested in this book, do send me, put it on the WhatsApp chat that you're interested, then we can make it available. And that person must be using Gmail. Okay, so that is that. Let's look at this question. Amunu Nigeria Limited has been in business for several years, preparing accounts to 31st December annually. You are given the following information about the company for the year ended 31st December 2021. How do you assess a company to tax? What basis? What basis do you assess a company to tax? What basis?
Preceding year,
Thank you.
2022 year of assessment.
Yeah, so this will be 2022 year of assessment. Thank you. Now you are given the following information: turnover, cost of sales, and gross profits, total expenses, net loss. Additional information. Included in the expenses are the following: cost of stamping documents, depreciation charge, withholding tax paid on rental income, refurbishment of equipment, repainting of building, of premises, pre-incorporation expenses written off, acquisition of plants. We talked about transfer to capital retention reserve fund for future development of the business. You are informed that as scrutinizing the company's accounting record, 400,000, which was meant for the managing director of the company, has been erroneously included in the turnover. What is the implication of that? What is the implication of that?
We'll make an adjustment.
We adjust it or how?
We deduct 400 from
We
the
deduct it.
turnover, meaning the turnover was overcasted.
Solid students, the 400K was overstated. The turnover has been overstated. Okay, let's go ahead. So the issue share capital of the company is 1.8, with the shareholder representing 300,000 are yet to pay the final call. Net asset of the company is 850. You are required to put the capital allowance, compute the capital allowance, compute the tax liability of the company for the relevant years, take into consideration the loss brought forward from immediate previous year is 22,210, and capital allowance is 385. Leaves the company's exempted from minimum tax, and at the same time, they also said what are the reasons behind the computation of minimum tax. So let's go. If you are there, I am there. So let's take one after the other. The first thing we do is to do our net adjusted profit. Let's go. In our adjusted profit, this company made loss of 200,000, right? So we said 200,000 loss. Now, cost of stamp duty is not allowed, so we disallow it. Depreciation is not allowed, we disallow it. Withholding tax is not allowed, we disallow it. Refurbishment is not allowed, we disallow it. Repainting could be considered as allowed, we leave that as allowed. And pre-incorporation expense is not allowed, we disallow it. Acquisition of plants is capital in nature, we disallow it. Transfer to capital retention reserve fund for future development of the company will be disallowed. Abi? And we said to correct the error that has happened, MD salary, which is supposed to be allowable, right? They said you are informed that as scrutinizing the company's accounting record, 400 meant for the MD of the company has been erroneously included in the turnover. It is the company's MD that owns it. So it's supposed to have been what? Treated as what? Expenses. Abi? But they went ahead and included it in turnover. To correct that error, what do? You credit your turnover, sorry, you debit your turnover. No, is it debit now? You reduce your turnover by that value and you increase your expenses by that value. Abi? So to correct
The net
that,
effect is nil.
the net effect is nil, yes, but the treatment is not correct. Do you understand me? The net effect is nil, we know, but for the purpose of computing our minimum tax, this value has been overstated. Do you understand me? And expenses too had been understated. You remember, this was overstated, expense was understated. To correct the understated expense, what do? You add more to the expense, Abi? But to correct the overstated sales, what do? You reduce it. So I am reducing these sales by 400. I am increasing my expenses by 400. So that is what has happened here. So expenses that is supposed to have been recognized is 400K. So we recognize the expenses. Okay? So that is that. So that means our loss self is even supposed to be more than it because we did not make up to 1.3 million as turnover. Do you understand? So our loss is supposed to have been like 600K. So instead of the 200K. So by the time we did all the adjustments, disallowing stamp duty, depreciation, withholding tax, equipment, what's it called? Incorporation expenses, acquisition of plants, transfer to residential reserve, and MD salary would have 130K. So balance brought forward of loss. They told us they have a loss of 210 that was brought forward. They also told us they have a capital allowance of 385 that was brought forward. So invariably, this company had no profits. So because it did not have no profits, they will not be taxed. But again, they will also be paid back their withholding tax. You know, it's supposed to be a credit. So we need to also compute our turnover. Our turnover is 1.3 million, right? And our MD salary is 400,000. We get our 900,000. So to compute our minimum tax, it is going to be 900,000 less frank investment income. But unfortunately, in this regard, this company did not make a turnover of 25 million and above. Therefore, it will be exempted from minimum tax. So the examiner is now asking you, the following are the reasons. They ask you, what are the reasons behind your computation? Why did you decide to compute minimum tax? We said, okay, because the company did not make a profit, minimum tax will become applicable. The zero profit of the company is less than the tax payable, minimum tax will be applicable, and so on and so forth. So that is that. So let's look at the next one. Let's look at the next one. This one is very important because the examiner has started testing your knowledge on this. So let's look at this question. The following information was extracted from the statement of profit or loss of ABC Limited. They are given turnover from main business, profit from discontinued operation, profit from non-core activity, rent received, dividend received from XYZ Limited. Note, the note to the accounts further disclose the following. Revenue from discontinued operation, 3 million. Less expenses on discontinued operation, 2.6 million. That is how they got this 305. Revenue from non-core operation activity, 5 million. Less expenses, 4.5. That is how they got this 500K. The examiner said you are required to compute the minimum tax liability of the company. Okay? So in computing that, what do we do? Let's go. Now, you remember when we were discussing minimum tax, we said you need to get the turnover of the company, right? Gross turnover. What is gross turnover? We said gross turnover is the income from sales and all other income of the company. Income from interest, royalty, dividend, and rents, and any other income that the company makes. Now, that means, you said? That means this company had made income turnover from its main business activity. There is supposed to be a turnover from discontinued operation and turnover from non-core activity. But the examiner had given us only profit from there. So, but here they gave us their revenue. So, in computing our gross revenue, we are not going to give cognizance to the profit. However, we will give cognizance to what? To the revenue from all these activities. So let's go. From this continuing activity, we have a revenue of 3 million. From non-core activity, we have a revenue of 5 million, right? So that will be taken as our revenue. So when I'm computing my revenue, I am taking turnover. This is not going to be profits. It's going to be revenue from my discontinued operation, which is 3 million. Revenue from my non-core activity, which is 5 million. Rent gross 10 million. Dividend 20 million. So the entire value is 31 million, right? As our gross revenue. But you remember we said you must remove tax, withholding tax, frank investment income. And the only frank investment income we have there is our dividend. Therefore, dividend will be deducted. So I am removing dividend of the 2 million, and we have my gross turnover of 29 million. On this 29 million, I am going to be charging 0.5% of that as my minimum tax. Any question? Any question? Any question? In the absence of no question, we'll go back to our main study.
Excuse me. In the latest Finance Act, which one is the latest now? Is it 2023?
Yes.
You know, you alluded to the fact that inflation has made 25 million to be very small. Was there any revision of this minimum amount? Is this still 25 million based on the latest Finance Act?
It is 25 million. The tax authority's eyes too is how do I say this in English? Ojú wọn sì ràn. They need more money. You get. So they won't be disturbing themselves with all this small money. So 25 million naira as a turnover. So how much will your profit be? So they don't want to be running after small business. Do you understand me? How much will your money be? How much will the tax be when you are going to pay tax? Do you understand? So it doesn't make sense for the time of the tax authorities to be wasted unnecessarily for showing a small amount of money. Do you understand? So that is why. I'm sharing my screen again.
I have a question.
Let's go ahead.
Okay, you said that 25 million, but why are we charging minimum tax for the revenue that was 29 million? I don't know if you get and I know
Less than you can, so if
not less.
If it is more than 25 million, we charge minimum tax.
Okay.
We charge exempt. Do you understand?
But if it is more than than 25 million.
Less than
I didn't
25.
get you. If it's less than 25.
You will not charge minimum tax.
Okay.
All right. So the next one I'm quickly going to look at is what are the benefits of early payment of tax liability? What benefits does the taxpayer get for paying tax liability early? Now, the Introduction of Finance Act encourages taxpayers to pay their tax liability at least 90 days before the due date. How many days? 90 days before the due date. So, if that is the case, if a taxpayer is able to pay his tax liability within 90 days, the taxpayer will be exempted from minimum tax. Sorry, will be given a tax bonus or rebates. Will be given a tax bonus or tax rebates. Now, if the company is a medium-sized company, such a company will be given a tax rebate of 2%. It's a medium-sized company. What is a medium-sized company? Gloria, what is a medium-sized company? Remind us.
Is greater than 25 million, but less than 50.
Less than 100.
Less than 100, okay.
Yeah. So we're now saying that a company that has a turnover of that has a turnover of between 25, above 25 million, but less than 100 million, and pays its tax liability before due date, that is within 90 days after the accounting year end, after they are done with the accounting year and pay their tax liability, they have a rebate of 1%. Sorry, 2%, if it is medium-sized company. But if it is a large-sized company, it's 1%. So that means a large-sized company is a company with a turnover of 100 million and above. Okay, so they will charge them a minimum tax, a tax rebate. They will give them a tax bonus of 1%. Now, this bonus is on the subsequent tax liability. I am saying it again. This bonus is on the what? Subsequent tax liability. Is on the subsequent tax liability. So that means if, for example, you have paid, you are assessed tax this year, okay, and you pay your tax liability early, okay, that means this year you will not be taking any bonus. You will not be taking any bonus. But next year, you will take rebates, you will take bonus. You will take bonus of what? 1% if you are a large company, or 2% if you are a medium-sized company, on the tax that you want to pay next year. Do you understand me? On the one you want to pay next year, you now remove the rebates, not this one. The one you want to pay now, pay it first. When you want to pay tax next year, that 1%, you will take it out from the tax that you will pay next year. That is what we are talking about. So there is a table here that talks about that. So the next one that we want to talk about is donation. The next one we want to talk about is donation. And that is what we will stop today. Now, I want you to also read up on this profit exempted from tax. Read them. There are so many, but it's something that you can read. Now, we're going to be talking about donation extensively. Now, according to Section 25 of SITA, if a company donates, such a company under the tax law has rights to recover the amount donated from the profit, provided that the donation you made or you pay or you give out to a company is in the body listed by Schedule 5 of SITA. Provided the donation are to bodies that is recognized in Nigeria, and those bodies are listed in Schedule 5 of SITA. That's number one. Number two, if you are a company making donation, the donation must not be capital in nature. The donation must not be what? Capital in nature. But when you make donation that is in capital in nature, you can only make it to a university or tertiary institution or any research institution. So that means this is an exception. You can make a donation of capital in nature to a tertiary institution or research institution. Okay, that is that. The next one, donation cannot be more than 10% of the total profits. Donation cannot be more than what? 10% of the total profits. But if the donation is made to research institutes or tertiary institution, it could be up to 15% of the total profit or 25% of tax payable, whichever is higher. Whichever is what? Higher. Whichever is higher. Do you understand what I'm saying? So if it is a research institute that you are donating to, this threshold of 10% of your total profits can now go as high as 15% of total profits. Or they look at the tax payable in that year and charge 25% of it. Whichever is higher will be allowed, the taxpayer will be allowed to relieve that on its profits. Do you understand me? Now, if that is the case, there are some bodies that when you make donations to will be allowed. There are 3 categories that I've mentioned here. The first one is when you make donation to a public fund. Number 2, when you make donation to statutory bodies or institutions. Number 3, when you make donation to ecclesiastical body, charitable, benevolence, educational, and scientific institution established in Nigeria, all those donations are allowed. Now, look at it, for example. Let's run through the list. Boys' Girls and Girls Brigade, when you make donations to them, they are allowed. Christian Council of Nigeria, it is allowed. So, Nigerian Museum, allowed. And so on and so forth. Red Cross, National Library. But I want to also say specifically that you cannot make donation to individual organization, especially when it comes to religious organization. When you are making donation, you can make donation to Christian Association of Nigeria. That will be allowed. You can make donation to Muslim Association of Nigeria, if there's anything like that. That will be allowed. But you cannot make donation to NASFAT, Corib. You cannot make donations to them. You cannot make donations to Redeemed Christian Church of God. You cannot make donations to Catholic Mission. You cannot make donations to Winners. Such donation will not be allowable. But if you make donation to Christian Association of Nigeria, such is allowable deduction. If you make donations to Muslim Association of Nigeria, such is allowable deduction. So you can go through all this at your convenience. Now, this is very important now. What is the tax implication of donation made during COVID? So during COVID, you know, a lot of companies were making donation here and there. Access Bank, 1 billion to governments to support government during COVID. Zenith Bank did their own, GTB, everybody were just doing it. So the act says that any fund if a company makes donation in cash or in kind to any fund set up by government to tackle exigencies, pandemic, or the natural disaster, such donation will be allowed, provided the company can provide some evidential documents. Provided the company can provide what? Can give evidence of such payments or such things that they have done. Now, that's number one provision. Number two provision is that the donation shall not be more than 10% of the accessible profit. It shall not be what? More than 10% of the accessible profit. Where the donation cannot be utilized due to no accessible profit in the relevant year, you can carry the donations forward for a maximum period of 2 years. Imagine, because of the restriction of 10% of your accessible profit, you cannot relieve your donation now. You can carry forward the donation for a maximum period of 2 years after the year in which you made the donation. So this is what I'm saying. You made a donation of 10 million. A donation of 10 million. And you have an accessible profit that cannot, and that donation is more than 10% of your accessible profit. When you calculate your 10% of accessible profit, you have 4 million. So the maximum you can take is 4 million in that year. That means the remaining 6 million will be carried forward to the next 2 years for you to be able to recover it against your profit. Now, note that your donation will be on first in, first out basis. The donation will be what? On first in, first out basis. That is, the donation that you made this year that you are unable to recoup this year, when you get to next year, when you have another donation, the one you must first recoup is the one you made you gave last year. Do you understand me? It's on first in, first out basis. So that is that about donation. And just like I've said, you could make donation in kind, that is in cash, or you could manufacture or procure items and give to what? To the government for the purpose of this donation. So that is that. So basically, we have two types of donation here. The first one is the donation according to Schedule 5 of SITA that says that a company can donate as high as 10% of its total profit. This one is saying 10% of accessible profit. They are different. They are different. So I have put this one here. It should be known that donation in Schedule 1, Section 1 to 5 of SITA should not be misconstrued for donation with regards to special intervention. Okay? So don't misconstrue it as what? Special intervention, as this one, because they are not the same. Okay? Section 25, 1 to 5 is restricting the donation to 10% of total profits. Why 6 and beyond is talking about 10% of accessible profits. So that needs to be checked appropriately. The next one is deduction for research and development. For any year of assessment, the amount the company can deduct as donation shall not exceed 10% of the total profit for research and development company. So if you have a research and development and they want to make a donation, the donation shall not be more than 10% for that company or the total profits. Okay, that is that. So we move on to the next one. Deduction not allowed. We know all those ones when we're talking about what was it called? Our No, we're talking about our trading profit and loss adjustments. It's the same thing all over. But let's really look at what is the tax implication of expenses incurred in deriving tax-exempt income. Expenses you incur in deriving tax-exempt income. What does that mean? You have incurred an expenses in deriving tax-exempt income. That means that expenses that you have incurred will not be allowable for tax purpose because the income is also exempted from tax. We are not going to subject the income to tax. Therefore, the expenses that you incur in generating that expenses, in generating that income rather, will not also be what? Subject to, will not be allowable for tax purpose. This is what we are saying. I am saying the income is exempted from tax. Therefore, any expenses that you incur in generating that income too will not be allowable for the tax computation. Because look at it, for example, the tax authority will not subject you to tax on the income that is exempted from tax. Therefore, you now want to bring in expenses that is not allowable. Sorry, expenses that is in relation to that income that has been exempted. Imagine you want to go for a contract and you have, let me look at it, for example. Okay, imagine you want to go for a contract, as I was saying, and in that contract, you incur some expenses, okay? And let's assume that this contract is exempted from tax, okay? We are just assuming. So you now made the income of 10 million on that contract. You incur an expense of 1 million. Since the contract sum income is exempted from tax, we are also saying the income, the expense that you generate, that you incur in generating that income of 10 million, which is 1 million, is not also going to be allowable for the purpose of taxation. That's what we are saying. Do you understand that? That's what we are saying. So look at it. Where a deductible expense is incurred to earn both taxable income and non-taxable income, to earn both taxable income and tax-exempt income, the portion of the expense that relates to income of accessible, the portion of the expense that relates to income accessible to tax shall be determined and allowed for deduction where the part of that expense, where the part that relates to tax-exempt income shall not be what? Why the part that relates to tax-exempt income shall not be what? Allowed. So that's what we are talking about. Let me see if I have an illustration on that so that you understand. So look at this, for example. Let's look at this one to buttress my point. Company XYZ Limited incurs 200,000 deductible expenses in generating business profit of 1 million. In the year ended 31st December 2019, you were informed that only the sum of 700,000 of total business profit is accessible to tax, while the remaining 300 is tax exempt. How much of the expenses will be allowed for deduction? Don't forget, they said 200,000 was incurred in generating both 700K and 300K. Don't forget, the entire value of business profit was 1 million. They now told us that 200K is total expenses. You remember, we said this 300K is not allowable. So how do you get the portion of this 200,000 that will be allowable for deduction? Who is helping us out? Jerry.
So,
how much? How many percent?
I'll be looking at it from the angle that is for the one that is so that will be subjected for tax is just make it 7/10 times 200 over 1.
That will be the one that will be allowable for what?
Yeah,
for tax. The one that will not be allowable will be what?
3 will be 3/10 times 200 over 1. 200,000 over 1.
That is 300,000 divided by 1 million multiplied by 200 over 1. So
1,000.
that portion is what is not going to be allowable. Let's go. So you can see allowable portion. You see that is 700 is the one that is allowable. 300 is the non-allowable. I said take the 700 to get the allowable portion. 700 over 700 plus 300 multiplied by C. C represents total expenses. So you will get your answer. Okay? So that means the one that is not allowable here will be 60,000. Abi, any question? Any question? Okay, in the absence of no question, that will be the end of today's class. When we come back in the next class, by the grace of God, we are going to be looking at other finance tax implication. Good day to you guys.
Please, was this material sent to the group?
Yes, it was. Please, Prudence, can you forward it to the class?